Hello and welcome to SPAC's latest series, our webinar series, as we're tracking all of the things changing regarding COVID-19. Delighted to welcome our guests from Taft Law. We have Kai-Misha Colomb and Dennis North. Both of you, thank you so much for being willing to share your expertise with us today.
You're welcome. Thanks for having us.
Yeah.
Please take it away. So much is changing for all of us, and staying on top of the latest developments is very helpful. So this is timely for us. Please take it away.
Great, thank you so much. So just high level, just wanted to thank you for the opportunity to visit with you, to give you some of these updates, and to really, this is also a small opportunity to introduce Taft to the St. Paul market a little bit, because I'm from Briggs & Morgan. So, you know, we're your old school blue blood St. Paul law firm, Briggs & Morgan, and we joined forces with Taft, Stettinius, and Hollister at the end of the year. And this webinar is precisely the reason we did that, because Taft gives us a bigger platform, access to some really interesting and important skill sets. And Kai-Misha is kind of proof of that, because without her, we wouldn't be able to do this type of a webinar. She's been leading our SBA task force firm-wide and has some great SBA contacts and great SBA experience. And so I'm just really pleased that we can introduce Taft a little more specifically to our folks in St. Paul. So really appreciate that. And do you mind advancing the slide, and we'll go to the next slide? So high level, you're all familiar with the CARES Act, Coronavirus Aid, Relief, and Economic Security Act, and it provided a ton of financing for existing SBA programs. Economic injury disaster loans and SBA small business loans. And then of course it modified those programs in significant ways that we'll get into. We're talking billions of dollars, right? So March 27th, $349 billion authorized for SBA 7A programs, the small business loan programs. Another $310 billion authorized on April 24th. So we have $659 billion, and the bulk of that has been allocated to the SBA 7A Paycheck Protection Program, which we'll get into in greater detail here. So next slide, please. Okay, so the Paycheck Protection Program, you've all read a lot about it. You're kind of generally familiar with it. $10 million maximum loan amount, double the customary 7A max for the existing SBA 7A loan program. And the loan amount is based on 2.5 times your average monthly eligible payroll costs based upon trailing 12-month period. And so a lot of people have been through that math, and there was a lot of confusion on how you calculated parts of those eligible payroll costs. And there still is, I believe, about $100 billion of paycheck protection funding still available. So if you haven't applied and you've wondered about it, I think there's still an opportunity to do so. So it's a small business program, and it's intended for small businesses, and the typical standard to determine if you're a small business for SBA and governmental loan programs is whether you have 500 employees or more. That's not a hard and fast rule, because the existing SBA small business guidance provides a different level depending on a couple of things, including your NAICS code. So there's a tool you can look up your NAICS code, and it'll tell you what your size standard is. So it might be more than 500, just something to think about if you're still doing that assessment. And then the Act made specific exceptions for franchises, restaurants, and applicants who were receiving financing assistance from small business investment companies, SBICs, that are sort of already in the SBA program, if you will.
Gotcha.
Next slide. Great, so the paycheck loan proceeds can be used for payroll support. So for all of the categories that go into that payroll support calculation: wages, insurance premiums, severance, state and local taxes, and retirement benefits, utility payments, mortgage interest payments, not principal, rent, and then interest on other business debt payments that were pre-existing. So the loan deadline is June 30, and you have to go through, an existing SBA lender, but there are plenty of those. And that we'll get into that June 30th period a little bit later in the program as well, because there's some things that tie off of that. So the beautiful thing about the Paycheck Protection Program is that it's a forgivable loan. So it's really intended to be grant money if you use it properly and if you use it within the time periods. And so if you don't use it all in permitted uses, the amount that is not forgiven will turn into a 2-year term loan, interest at 1%, loan payments deferred for 6 months from the time that you take the loan out or till the repayment period starts. Borrower and lender fees are waived. There's no prepayment penalty. There's no requirement of a guarantee. There's no collateral requirements, all of which were typical SBA requirements. And importantly, one of the existing SBA requirements for small business loans was they had a standard that said you can't have any credit available elsewhere, and they had guidance on what that meant. And the CARES Act specifically waived the no credit elsewhere requirement for the Paycheck program through June 30th. And that's become a source of a lot of consternation for folks, as we'll get into in a little bit. So next slide, please. Okay, so I'll turn it over to Kayamisha now, because now it's going to get technical and difficult, and that's what I said. I'm an expert here now. So Kayamisha, do you mind talking about a little bit about some of the guidance that's come out?
Sure, I'd be happy to. But before that, we did have a question, so just so we stay on top of those. The question was, with PPP, what is your option on paying a bonus or temporary increase in wage? So what I would say to that is you can pay a bonus so long as it's in the ordinary course of your business. So if you normally pay bonuses, then yes, you can go ahead. If you usually pay an annualized bonus, I think our viewpoint has been you can prorate that by 56 days and then pay it out during that 8-week period. I use 56 days because for some clients it's an easier concept than 8 weeks. And so long as you would then prorate that bonus and then pay it out during that same 56-day period, then that would work. So hopefully that answers your question in regards to bonuses. Other bonuses or prepayments are not allowed. And in terms of a temporary wage increase, what I can say is that there's nothing in the Act or supplemental guidance via the interim final rules or the FAQ that would deny you increasing a wage for someone because of hazard pay or something of that nature. So I think so long as you can substantiate it and it's something that's, modest and not, sure to flag someone, it would probably be just fine. There's nothing against it. So the FAQs have been a field day, and they are ever evolving on a constant basis. They got their last update on the 13th, so 2 days ago. But through this process, there have been a lot of updates. So we sort of chose a few that we thought we could bring to everyone's attention. So the first one was FAQ 2. Now these FAQs, they're based upon the law that already exists, whether found in the Code of Federal Regulations, the United States Code, the CARES Act statute, or the interim final rules that have been provided. That's what the FAQs are supposedly based upon. And you can rely on them, but they do not come before any statutory authority. Okay, they're not a higher level. So for question 2, it was alternative size standard. This one is if you weren't able to get into the program because you had under 500 employees, or you weren't able to get in the program because your NIAC code didn't provide either the revenue number you needed or it didn't provide the employee number you needed. This was a third standard. And then within this standard, what the SBA said was, it was 2-pronged test. You had to have a tangible net worth of no more than 15 million. Okay, and then the second prong of that test was that the average net income after federal taxes, and this excluded any carryover losses, had to be for the past 2 years an average of no more than 5 million. And if you fit within that standard, then you are eligible to apply and were considered a small business. So there were a few different standards, and this was one that came just through FAQ 2 and provided folks that couldn't fit in the other ways to fit in this way. The other FAQ that came out was FAQ 3. And this one was important because it specifically had language in it which made folks believe that they no longer had to pay attention to the affiliation rule related to how you count employees and the inclusion of foreign affiliate employees, because it had, it was commaed probably inappropriately, saying 500 employees had to be located, their principal place of residence had to be in the US. So that gave a lot of people the idea, okay, well then we only need 500 employees in the US and our foreign employees don't count. That's not true, okay? The Code of Federal Regulations within section 121 CF, so 13 CFR 121.301 and then 121.106 tells you how to count employees for eligibility purposes, and you do have to count your foreign employees that are part of the foreign affiliates. And then in FAQ 44, they confirmed that because enough, I think, just confusion had come about that they then pulled precisely from the code and said, no, you still have to follow this, okay? The FAQ 5, that was whether the affiliation rules applied and which affiliation rules applied, because affiliation rules are found in 2 sections of 13 CFR, in 120 and then in 121. And they said it's section 121.301F precisely. All of those affiliation rules do apply to your company unless you are within one of the waiver categories. And Dennis already spoke to that a bit, right? So there were 3 waivers within the CARES Act itself, followed by another waiver that came out once they allowed religious institutions. They then provided a waiver for those religious institutions that was faith-based. So, right, the Catholic Church could apply because they were no longer affiliated with the Vatican, that type of thought process. And then question 20 has been a pretty hot topic, and I'm surprised that we're still getting questions on this now, that folks have read information that says my 8-week period doesn't begin until my doors open. No, that is not the case. That is very, very wrong. Your 8-week period starts as soon as the bank funds the loan. Okay, so the day that the funds were deposited into your account, that is the beginning of your 56-day period. So you take that date and then count 55 more days, and that's your 8-week period of time that is, special for loan forgiveness. The next one was a 36. That was pretty big deal, and this was just how you calculate employees that are eligible for loan forgiveness. So let me just go to it quickly so we don't come out in any other way. So for loan forgiveness, this specifically makes, there's a difference between the CARES Act and 2 sections, in particular the PPP. Okay, there's section 1102, which sets up your guidance and procedures and such for the PPP program in general. And then you have section 1106 that focuses solely on the loan forgiveness aspect of the PPP. And you'll find different definitions within each section. So that's a bit tricky. So for here, employees for eligibility for loan forgiveness, you count them by your FTEs. So it's what's a full-time equivalent. So a full-time employee is someone at 30 hours a week, okay? And then your full-time equivalent, there is still some guidance that's needed, but what we do know is that the SBA has 3 different formulas that you can find within their regs that they've used for calculating full-time equivalents. Yes, 3, I know, confusing. The first one is 30 hours a week. The second one is 40 hours a week. And the third one is 120 hours a month, okay? So at this point, I say pick which one suits you the best, and then we can argue and point to the area in the reg that we're relying upon, because they have yet to give us loan forgiveness guidance. We're supposed to get that on April 27th, and well, it's May 15th. So there you go.
Amisha, I have a question for you.
Yeah.
When you refer to the regs and you're giving these particular paragraphs, if someone really will need to look that up, where do they find that specifically? Is that an SBA reg? Is it an IRS reg? You might have said it.
So when I refer to the CFR, that's the Code of Federal Regulations.
So someone would Google CFR or Code of Federal Regulations.
Yeah.
And then
they could Google 13 space CFR space 121.301 paren F N paren, and that'll take them most likely to the Cornell site. I would not trust that one because these regs are actually being updated currently with the interim final rules that are passed. So I'd look for the government site, which is usually down because there's not an ad attached to it, and use that site.
Great, thank you for that.
Yeah, sure thing. So, okay, so for the loan forgiveness, we're using FTEs, okay? And you have two choices in terms of how you compute that number. Your first one is going to be the first 2 months of this year, okay? You would, from January 1st through February 29th, you average what your FTEs would be. Or at your choice, so at the borrower's choice, they can use that period of time, or they can use whatever 56-day period is for them this year, so the 8 weeks for this year. They can look at that same exact period of time in 2019 and calculate the FTEs during that period of time, and then use whichever one they want to use. Section 1106 of the CARES Act provides for that. And leaves it at the borrower's choice, okay?
So let's talk about that in more detail, Kaimisha, because that one could be tricky. Sure. So a company is in the midst of this challenge. They've laid off, or for that matter, laid off temporarily or permanently gone through a reduction in force of X number of employees. So their employee count moving forward is lower than the same period last year. That might be confusing in terms of demonstrating consistent numbers moving forward?
So there are a couple of exemptions that have been given, sort of a few Hail Marys, if you will, as it relates to this. So the comparison period is going to be between their 56-day period now versus those other two periods I spoke about. Mm-hmm. So if they had, I'm just going to use round numbers for an example. If they had 100 attorneys, or sorry, not attorneys, 100 employees, and they now only have 90 employees during the 56-day period as their average, okay, there's a few things that can help them out. If those 10 employees were laid off or furloughed between February 15th and April 26th, and you can document that you requested that they come back to work in a written format, and they refuse to come back to work, and you document that, then in pursuant to FAQ 40, you won't suffer a reduction in forgiveness, okay? That's one helpful tool. The other helpful tool is found within the CARES Act itself in Section 1106, where it states that if you cancel out, right, the reduction in force or the reduction in someone's salaries, and I'll get to that a little bit later, by June 30th for those same time period of employees, okay, that were either furloughed or salaries were reduced between 2/15 and 4/26, that then they'll make it right as rain, and it's like it never happened so long as you get your numbers back up to where they should be, so back up to that 100 by June 30th. In the event you're able to, let's say, get 95 back up to June 30th, but then those other 5, you have proof that you have letters for, I offered them their job back, they said no for XYZ reasons, and you have that in your file, then that should be sufficient when you combine those two exceptions together, that if everything else was done appropriately, your forgiveness should not be reduced.
Alternately, can you apply for a PPP based on the 90?
So no.
Previous 12 months?
Your PPP loan, in a way you can, but in a way not. So let me clarify that. Okay, your employee count is over the trailing 12 months. So that's what you should have written down. So if over the trailing 12 months, your average employee count was 100, right? That's what you needed to have on your application. That doesn't affect your FTE period going forward, right? Because your FTE period is based on a completely different time period than what your eligibility criteria in terms of an employee count is based upon. They're two separate things. But if you wanted to take less money, you absolutely can, right? So average salary, monthly salary, let's say is $10,000. So now you have a loan for $25,000, right? Because it's 10,000 times 2.5. So now you're at the $25,000 mark. And just because you've already had communications, I'm not going to have the same FTEs when I do that math, and I'm not going to hit that amount. So then you do the math and you figure out, I only need 20 because I'm only going to be using 15 for payroll, and then the other 5 for rent or utilities, etc. You can do that. You just take less of a loan amount. That's completely okay. The other questions that I'll just stop and try and answer are, after the 8 weeks are completed, are there any requirements to continue paying the same salary level or keep the same number of employees? No, there is no requirement within the CARES Act for this at this time, and there's not been anything stated about it within supplemental guidance. The next question was, for determining loan size, we were able to include payments made to temp agencies as part of payroll. Can we count payments made to temp agencies during our 8-week spend down as part of the loan forgiveness application? So this gets a bit tricky. If you pay for their taxes and such, yes, you can include them because they are employees. But if not, you can't, and that's really specific on different temp agencies and how that runs. Because the temp agency itself may have applied on its own behalf, and if they're the ones that pay taxes for that employee, then that employee is being counted on their PPP and can't be counted on yours. Okay. So application request number of employees, not FTEs. That's correct. Your application, remember, there's a different criteria for the eligibility versus loan forgiveness. When you count employees for eligibility, you count all employees, right? A part-time employee is 1 employee, a full-time employee is 1 employee, a temp employee is 1 employee, okay? For full-time equivalents for loan forgiveness, that's different, right? You have to sort of combine employees in order to equal that 1 full-time employee at 30 hours. So hopefully that answers those questions. The next one that was up was a big one, was question 40. If we could go back just one, yeah. So what happens to my loan forgiveness if laid off or furloughed an employee? And this is what I discussed in terms of you have to provide them with a written offer for rehire and then document them. Thank you. I just want to make sure. The next FAQ that came about was 45, and that was a pretty big one too, because a lot of folks have now returned their PPP money for whatever reason. They got nervous about it. They didn't like the whole debacle regarding the certification. Maybe their business just isn't going to open up at all, and they just didn't see the point, so they rather go the employee tax retention credit route. So if your PPP is returned in full by now, because it's been extended May 18th in terms of that safe harbor date, you can apply for an employee tax retention credit, okay? Whereas if you have a PPP loan, this is under Section 2301 of the CARES Act and is not applicable to you at all. But you can still take advantage of Section 2302 of the CARES Act, which has to do with tax deferral. And you can take advantage of that until you receive word back from the bank that your loan is in fact forgiven. And then you have to stop taking advantage of that tax deferral. And whatever amounts are owed, half of that has to be paid back by December 31st of 2021. And then the other half would have to be paid back by December 31st of 2022. So now we go to the necessity certification FAQ that came out and literally threw like a bomb in all of this.
Mm-hmm. This is when people got nervous.
Yes, this is exactly when people got nervous, and rightfully so. And, you know, Dennis alluded to this earlier, right? The CARES Act does not have a credit elsewhere test, okay? And what we find really interesting as attorneys that are nerdy and sort of just working through all of this stuff, and especially in our SBA task force, which I really just revel in, I love all of the just collegiality within our group, is that the FAQ states something very different than the interim final rule that was supposed to cover this same exact thing. And I think that was done on purpose, okay? So this is just like the opinion, I think, from our task force, but we're pretty sure that that was sort of like a publicity stunt by the Department of Treasury in saying, like, you need to look at your capital, you need to look at your personal funds, et cetera, because that's nowhere within the CARES Act. It specifically states that there is no credit elsewhere test. Furthermore, within IFR 4 is where I believe this one is found. It also doesn't state it there too. It just states that they are asking you to recertify to the necessity certification. Mm-hmm. It doesn't mention anything about looking at capital or looking at your personal wealth or anything of that nature. So here we really do believe that the SBA exceeded its authority, right? The agency, both the SBA and the Department of Treasury, those agencies were afforded within the CARES Act with a certain amount of authority, but by no means were they given the right to change law. Within the act, the words that were used by Congress precisely, that they were giving these agencies, quote, to carry out this legislation, okay? So it's our opinion they exceeded their authority. Now, they've come back and they've helped a little bit in clarifying it. So 37 or 31 was focused on public companies. 37 was focused on private companies. So the only ones they didn't cover were the nonprofits. So I think nonprofits probably have the least to worry about in terms of a necessity certification because they weren't specifically called out in 31 or 37. But then they came out with clarification a day before the first extended deadline for the safe harbor. Nothing like waiting to the last minute. And in that clarification, they stated any loans less than $2 million, they are going to essentially state and assume that good faith was made in terms of that certification. So there's going to be a presumption that there was good faith for any loans under $2 million. Now, something to consider, though, is that it's borrowers and their affiliates, okay? So what they're telling you there is that they're aggregating these loans. So if, you know, Company A is affiliated with Company B and they both got a loan for $1 million each, they don't fit within this presumption, right? They are then getting automatically reviewed when they apply for loan forgiveness. Another question that comes from that affiliation is, well, what if my company qualified based on one of the affiliation waivers that is found within the CARES Act or the supplemental guidance? Our task force has taken the belief based on a review of the law, and especially because the certification language is found in the same section of the CARES Act as this requirement would, this waiver for affiliation, is that it would in fact apply. And we think that there's a really good basis to argue that, but there has not been anything specifically noted other than a small footnote within the FAQ that brings up the interim final rule regarding affiliation. So we do think that there's a really good basis for that argument if needed. And then what 46 states for anyone over the $2 million is that they are going to need to show an adequate basis for this need certification. But there is hope, okay? So if the SBA decides they disagree with you, they look at all your information and say, no, we don't think that you had a need for this loan, then the borrower can immediately repay those funds, and then there won't be any type of enforcement actions that are pursued. If they don't immediately pay those funds, then there will be enforcement actions. Essentially, that is the SBA is going to say, hey, DOJ, Pandemic Response Committee, Office of the Inspector General, you guys review this file and hash it out. And then at that point, you're definitely going to want to get legal counsel involved so that we can, help with providing really great arguments and substance. Additionally, for folks that want some comfort and just some acknowledgement, our task force has been reviewing and going through an analysis with folks to describe and show what necessity is, and then sort of pulling out for you what documents you should have within a file, and sort of building a case and helping you build a memo to the file so that this way you're ready for that audit, especially folks over 2 million, because that audit is coming. And folks under 2 million, some folks have wanted us to do this for them as well, because they know that there's still a chance of them being randomly audited. And we can go through that and provide at least, a position statement and saying, we think that based on all this information you provided to us and shared in this documentation, that we, think, yeah, you have reached good faith. You've met that standard, okay? Now, we may also go through that with you, and it may become really apparent that you do not meet that standard. And then in that case, you have until May 20th and pursuant to FAQ 47 in which to return those funds. And the SBA will just deem, no harm, no foul. You made the certification in good faith. We got paid back. The only real issue I see here is for companies that, they believe they're doing this in good faith, but perhaps they're like right on the fence. And then the SBA comes back and says, nope, we don't agree with you. And then they're sort of stuck in this position where they probably would have furloughed or laid off people, not use those funds. And now they're being told to repay those funds immediately, and they may not be able to. I would think that that would be an argument to show that they did in fact, need those funds. But I'm sure there'll be a case or two out there like that. And in that sort of instance, I do feel for those borrowers, because they're just going to have to go through a lot of probably jumping over of hurdles and steps. We are still waiting on some additional guidance to come out, like I mentioned earlier, and hopefully that will also be helpful. And there are some things that are up in the air that really need to be figured out. And we'll go through that, I think, in a bit.
Can you see the question that's up here? Because I think this is
sure.
Before you change topics.
Yeah, if you receive PPP funds of 2.1 million in mid-April, can you pay back 101,000 by May 18th and thus fall into the safe harbor category? No. Yeah, so unless different guidance comes out, in just regular commercial finance world, that's just a prepayment. That has not amended your note. That has not changed anything on the SBA's e-trans system. So when they're reviewing this and they're looking at your application, that's the number it's based on. So all it is that you paid back a portion of your note. So audits and enforcement risk. Our firm's website, we've got some great materials for folks to review. And our SBA Part 8 really dives into this. So, folks, please go to taflaw.com, go to our COVID toolkit, and look at those materials, especially SBA Part 8, if you're really curious on these audit and enforcement risk. But essentially, this boils down to that Congress provided $25 billion to essentially hunt out fraud and make sure that these funds are used appropriately. The DOJ has done this before, back in 2008 and 2009 with TARP funds, and you are subject to audit based on those items in the False Claims Act for up to 10 years. Okay, so just because you're audited automatically during this first round, they're looking for very specific things. Your loan could still be audited a second time. And if you're under 2 million and you're obviously not automatically audited, you're still subject to random audit. So make sure that you document your file, that you put a memo, that you talk to your professional advisors, like folks at TAF Law or others, in order to help you make the best decision and really help you, move forward appropriately.
Can I ask you a question, Kamisha?
Absolutely.
So we have, our accountant has echoed your advice about a memo to file. Given knowing what you know right now and the decisions you're making right now, document it. You're going to forget things, right?
Yes.
Take the time to set up that file. We've done the same thing. We're trying to determine, as a 501c6, of course, we're not eligible for a PPP, but if we explore an employment tax credit to demonstrate and talk through justification for that. So I just wanted to amplify that. And then I have a question for you too. You'd mentioned in passing this idea of applying for loan forgiveness. Can you go through the process? What does that look like? I've applied for a PPP. I've been awarded it. Certainly there's justification given my business model as an example. Now, what's the next step? I need to apply for forgiveness somehow?
Sure. So I think if we advance the slides, we've got a whole section on loan forgiveness.
Oh, sorry.
And we'll go through that. No, let's
spoken
about this, so we can skip this slide as well.
Yeah, we can skip a number of these slides because it really just talks about the chaos that ensued with some of this FAQ guidance, which I think we've largely covered. So I think we can move into forgiveness because I think that'll probably cover the balance of the time because it's a very technical.
Yeah, sure. Yep, you can keep going. Hold on 1 second. Go back. Go back one more, please, if you could. Okay, so just to finish this off, Dennis, do you want to mention this part just to sort of wrap it up on this area?
Sure. So this is the guidance we've provided to our clients, especially those who have the loans of $2 million or more, is obviously do your homework and get this in the file. And so we have material that we have created sort of a summary list of factors to consider when you're doing your need certification backup. And so this is a kind of a partial list of that, but, address your existing credit arrangements, terms, conditions, limitations on it. If where your debt covenants are, when you might trip your debt covenants, based on your forecasted loss of revenue through this. And then assess, could I get additional debt financing? And, if you have existing credit facility, it might prohibit that. It might be prohibitively expensive, but, sort of ask those questions so that when you're in an audit and an auditor asks you, tell me about your debt and why couldn't you just borrow more money? You've done that analysis. Same thing with equity financing because, they threw this, liquidity test or concept out there in FAQ 31. That's what got everybody scared. It's like, do we really have to go up the chain to owners' pockets? And so part of your analysis should be, whether there's that kind of possibility available and what the limitations on that might be. We've had clients who, the existing owners had just entered into a transition plan and sold their portion of the business to new owners. So they're not going to put more money in when they've already sold their business. They may technically still own it, but they're not going to put more money in. So you want to give some thought to that. And then obviously the cash position and your cash burn and other liquidity to maintain operations in a short and a medium and a long term, right? So this is not merely how much cash do I have now and how much will I have during the 56-day period. It's really what's my business, forecast look like. And most people are running scenarios to say, based on the first couple of months of this, here's where my revenue is projecting. And then so let's do a best case, a medium case, and a worst case scenario, and then apply your cash analysis and liquidity to that to say, look, even if I tapped my existing line of credit and used all my cash, in 12 months, I might not still have enough money, right? Because no one really knows, and that's the nature of this uncertainty. You don't know what your business is going to look like. So, and then just to identify, if you've lost specific projects, to identify, we lost this project and that was going to put this much earnings and revenue into our bottom line. Assess the impact on your personnel and your business operations in general. I had a client who has now had 3 positive coronavirus tests in their office and their operations. And they've had to get cleaners in. They've had to, you know, key members of their workforce now are, of course, getting healthcare and quarantined after that, right? And so documenting that. And then costs. Did you have to buy computers and, you know, cloud storage to get people working from home, as well as laying out a little bit from your own perspective, the impact of this on the economy, national and local, and on your customers and vendors. Those are the kind of things when you're building your case that you're going to want to have in your file. And then what Kayamisha mentioned is that our task force is happy to plug in when you've done that analysis to, you know, kind of walk through that with you, stress test it a little bit, you know, and in appropriate circumstances, we are providing some comfort. They're not really comfort letters, which are a thing in investment banking, but it's a concept that, you know, if you've done really good analysis, you know, that's the basis for a good faith statement, right? Because the risk profile is if you have taken these loans out fraudulently, well, I can't help you there, or with reckless disregard. And so, you know, you're trying to get under that reckless disregard standard, and this is how you do it. And one other way that, you know, if it's appropriate in the circumstances is, you know, a letter from your law firm that says they went through the analysis, and based on, you know, assuming the accuracy of that analysis, you know, we think that that they've got they're likely to have met the good faith standard, something along those lines.
Yeah, it's perfect. Okay, you can advance. Dennis did that beautifully. Okay, so loan forgiveness, which is a hot topic on everyone's mind. So I start this out with, this is the loan forgiveness guidance that we have as of 1:44 Eastern Time on May 15th. Because this
it's not very good
by the hour. Yeah, I'm not trying to be facetious by any means. I mean, this is truly what is needed for this program. So borrowers are eligible for loan forgiveness related to the PPP loan, right, from that 8-week period. And I talked about it in terms of 56 days, because sometimes that's just more quantifiable for folks to piecemeal on. And you can use it on eligible payroll expenses, okay, mortgage interest payments, not principal, rent payments, or utility payments. Utility payments do include internet and cell phone, okay, so that's allowed. It also includes gas for business vehicles. And then within one of the interim final rules, they also provided leeway in that if you have a business such as like a food truck and there's a loan on that, you can pay the interest on that loan because that is your business, okay? So they allowed that as well. That's not found in the CARES Act, that's found in one of the interim final rules, all right?
Point of clarification here, Kayamisha. On
Sure.
bullet number 1, when you mention rent payments and or utility payments, so long as all payments were obligations prior to, not that the bill was due, but that I don't go out and get a new phone system and do a whole bunch of stuff after 15. You're just demonstrating the continuity of bills, right?
Yeah, that's perfect. Yeah, I don't need to answer. You answered it. You did a great job. You want to join my team?
So please, I am a student and I'm very, very interested in more. So keep going. This is great.
All right. So yes, they had to be around at that time. Okay. And one rule is that, and this is getting really difficult for folks. Okay. So for folks that applied after May 5th, your 8-week period is now into July. The CARES Act states that these loan funds can only be used until June 30th. Now we feel that because of Section 1106, you have a really good argument to say that, no, I can use them for the full 8-week period of time. That's my loan forgiveness time. But the SBA and Department of Treasury, they've got to come out with guidance that fixes this. Because anyone after May 5th that has gotten a loan, they are now, their 8-week period does not correspond with the CARES Act. Okay. In the CARES Act, it states that funds could only be used between 2/15 and 6/30. But that the loan forgiveness portion is that 8-week period of time after you're funded. Now, for folks on May 5th, that means that the time they could use these funds and their loan forgiveness period of time are the same. It's this 8-week period of time. But for folks that got it very early on, where their 8-week period expires, let's say June 15th, right? They still have the opportunity to use these funds for 2 additional weeks. It's just those 2 weeks are not forgivable. So any amounts expended during those 2 weeks would be non-forgivable uses, okay? But there are certain things that you do have to do no matter what. And that is that 75% of your loan proceeds, so 75% of your original loan amount, must be used on payroll costs. So if your original loan amount was $1 million, $750,000 must be attributable to eligible payroll costs. If not, whatever monies are not attributable, that's a misuse of funds. So let's say you only use $600,000 towards payroll costs, okay, and then you used the $400,000 towards rent and interest and other items. $150,000 was used inappropriately and will be required to be paid back immediately, okay? And that's looking at it in the best case scenario, right? That's saying there's no fraud, there's just sort of an honest mistake. Someone didn't attend a webinar like this, and they just didn't know, all right? The other rule is that 75% of the loan amount eligible for forgiveness must have been spent on eligible payroll costs as well, right? So for many folks, after May or close to May 5th, right, your 8-week period and the time period you can spend these loans is basically the same. So 75% must be reached in order for you to be eligible for loan forgiveness in that circumstance, okay? So we have asked questions of the SBA in terms of, well, couldn't you like back pay yourself payroll in order to meet that 75% threshold? And their response has been no. But the CARES Act does state that, right, you can use it for any time between 2:15 and 6:30. So there are real issues with the loan forgiveness that do have to be flushed out. But what we can tell you now to be, you know, safe and to sort of guarantee that you're not going to have an issue is use 75% of your loan proceeds on eligible payroll costs within that 8-week period, okay? And if you do, you are guaranteed, okay, to at least have 75% of your loan forgiven. And then we're looking at the other 25% for, you know, did you use that appropriately? Did you use it on the right utilities? Did you use it on the right, you know, mortgage interest or rent? And if you have additional payroll, you can also use that portion on additional payroll, or you can choose to only, if you're only going to use 20% of it, use the 20% of it, you keep the other 5% and you make that as a payment back to your loan so that this way you don't have to, you know, incur any other interest charges on it. And then if that was the case and you met all of the other qualifications, then at that point, 95% of your loan would be forgivable. You paid back the other 5%. And the only thing you owe is 1% interest for approximately 2 months on that 5%. Okay. Now, once you hit that 75% threshold attributable to payroll costs, then the other portions that you need to, or the other items affecting loan forgiveness is how you're using the other 25%. And then the other items are, okay, did anyone's compensation, and this is specific to an employee, okay? This is like, you know, Jane Smith, in the first quarter of this year, she averaged $500 a week. But during the 56-day period, she only averaged $300 a week. Well, she then made less than 75% of what her normal salary was. So then anything in excess of the 25% difference, that's going to become a dollar for dollar reduction off of the borrower's amount that they can get forgiven, okay? And this is only for employees that make $100,000 or less. So if you have an employee that makes $100,000, you can bring their annualized salary down to $75,000 and that doesn't affect you. But the moment you bring their salary annualized down more than that, that's when it affects you and it becomes a dollar for dollar reduction on forgiveness. Okay, and that's specific for employees.
was wondering, we did get an interesting, very technical question about FICA in the questions. Could we maybe
Oh,
touch
sure.
on that? That'd be great.
So the question is, what do employers do who obtain loans that included FICA during, due to the timing of the guidance coming after disbursement? So the CARES Act itself stated that FICA was not supposed to be included, but I do know that many banks got this wrong. You can communicate with your bank, and they are supposed to be reviewing all of their files and making sure that the information that they inputted into the E-Tran system is correct. So I'd communicate with your bank, explain the situation, and ask them to update your application within the E-Tran system, okay? And then you may need to obviously amend your note, because it probably is going to also change, not probably, it will change the loan amount that you were supposed to receive. And you're going to need to make sure that that is changed and updated in the E-Tran system, and that your note is amended so that it shows, you know, an original loan amount in the lower portion. Otherwise, if that's not what you would do, or you're going in, I would calculate, you know, what that portion was that was wrong in your loan amount, and I would just pay that portion back now, and sort of notate the file.
And hope that it doesn't mess up your 75% analysis.
Exactly. Yep. And hope that it doesn't mess up the 75% and notate the file. You know, that's not my grade A choice. My choice is, first you call your bank and you have this amended and made proper. But if they refuse to do that for any reason, I'd still fight them on it. I tell them call their local SBA office, knowing that this is what's supposed to happen. But if you absolutely get nowhere, because I know with a lot of different banking institutions, they're overrun and not enough time in the day to handle all this stuff, then I would at least document it. Like, I sent XYZ emails trying to figure this out and fix it. It has not been fixed. So at this point, you know, here's the calculation that I should never have received in the first place. You know, document, because at the end of the day, you may have to show that, and essentially, you know, hope and pray that by showing them that documentation, they're going to provide you with some leniency in sort of flushing out the rest of your loan and the amounts and proportions, okay? The other item where you can get your loan forgiveness reduced is employee headcount, okay? And that's the FTE that we spoke about earlier, I think in some pretty significant detail. So I'm not, you know, doesn't move me to sort of go through all of that again. I think we covered it, but those are the two other items. And then remember, there were some exceptions if you qualified for them. We could probably move forward. Dennis, do you have anything else to add to this?
No, you know, the only thing I have to add is, it seems like some of these thresholds that have been set, for example, the requirement that in order to be eligible for forgiveness at all, you have to spend 75% of your loan proceeds on payroll costs. You know, we're finding a lot of clients that are having a hard time with the math, and that are, you know, close, but maybe not quite there. And there's a real concern that it's not the right result if they spend 73%. Is nothing forgivable. And so we're hoping we'll get some guidance that gives people some comfort on that. But for now, it's a fairly draconian kind of a cliff, if you will. And so keep your eyes peeled for additional guidance, and we'll do the same. Yeah.
The other thing I would say for that is that every time I talk to clients, a lot of times I'm finding that the reason why they're having a hard time meeting that 75% is that they have hourly workers, and while they're like, I've kept the hourly workers making the same amount, and they mean the wage, right? But not their paycheck, okay? And that's a really big difference. So remember that you included those hourly workers at, you know, if they were working 30 hours a week before, that was what was included in order to make your average monthly salary. Mm-hmm. That's the same that has to go out. So if those hourly employees now are only working 10 hours a week, you've got to bump them up. And yes, that means paying them to stay home. And I know a lot of people have moral issue with this, but this is why this this legislation was passed. The whole and complete reason why. So while I understand people's frustration or disagreement with paying people to stay home, that's the point. And if you don't, it's going to hurt you, because then the loan will not be forgiven. So, you know, trust that the legislature did what they truly wanted to do, which was to essentially make sure that this was just a hiccup, right? People, okay, go home, do what you have to do. Let's get over this. You know, don't go find another job because I don't want to lose skilled labor or, you know, folks that know how to run the cash register, right? You just then, when we open up, you just come right back into your job. But in the meantime, you were paid, and think of it as someone essentially being paid to wait until you're ready to bring them back into the position that you want them to come back into, right? Or else they could have gone and gotten another job, etc.
So Kaimisha, we have a question on the board, and then I have one after that, please.
Sure. Is payroll supposed to be prorated if it doesn't match the loan forgiveness period? Same question for rent, healthcare. Yes. Yes, yes, yes. So prorate. So if your 56-day period, your 8-week period, you let's say pay bi-monthly. So your period ends, let's say June 12th, but your pay period really doesn't end until the 15th, right? You're going to pay with PPP loan proceeds June 1st through June 12th, and you're going to pay it out on the 12th. Because as you see in number 7 on the screen, that's the calculation. It's payments made and costs incurred within the 8-week period is what's eligible for forgiveness. So that means you're going to run an early payroll, or if you use a payroll company, you're going to then make sure that the payroll company has those funds and that they're out of your possession, okay? Now, on the alternative, right, if you got the loan, let's say April 14th, right, and you pay bi-monthly and, you know, you made your payment on the 15th, you can reimburse yourself for payroll for the 14th and the 15th that you already paid out. Does that make sense? All right, so yes, you can prorate. Same with your rent, okay? Just make sure that these amounts are paid within that period of time. That's why I said for folks that normally do bonuses, you can prorate the bonus. So you can prorate all of those items.
I have a question then too about when is eligibility determined? When do I know I'm good, or how do I go about the process of ensuring my loan has been forgiven?
Okay, so that's a bit of a time period thing, and honestly, it's probably going to turn into a little bit of a cluster, let's be honest. But the way it goes is this, okay? At week 7, you can start to put together your loan application package. One caveat, the SBA has not released its loan application package yet. So when they release it, then you would fill it out and provide all the documentation they're going to need. What I can tell you in advance is they're going to want all your payroll information. They're going to want payroll rolls in terms of the names of your employees, what you spent it on. If you said that you paid rent, they're going to want, you know, stubs for that, or a copy of your lease, and then you show the wire transfer confirmations or whatever that might be, or a letter from your landlord. I mean, there's tons of ways to document this stuff, but they're going to want documentation for it. The same with your utilities, same with mortgage interest statement, all of that stuff. So make sure you're gathering all of that and that you have it ready to show. The most important piece is that 75% proving you've spent it on payroll. Once you hand that to the bank, okay, in accordance with the CARES Act timeline, and I tell you these timelines, but I sort of laugh at them as well because we've already seen what has happened with other timelines. Okay, so big caveat there, don't hold me to these. The bank has 60 days in which to go through your package and essentially come up with what they are going to submit as a recommendation to the SBA. In terms of either a portion of your loan gets forgiven or all of your loan gets forgiven, whatever that might be. And then they also have to take the package you gave them and sort of rewrap it and send it to the SBA. They've got 60 days to do that. Then so the SBA.
Go ahead. We're running out of time, but I want to make sure we get a chance to make sure folks know how to get a hold of you. So, and we've got one more question too.
Sure. So then the SBA and Department of Treasury take 90 days, or they have 90 days in which to review the package and then let the bank know we either agree with you or we disagree, we have more questions, whatever it might be. Once they have come to a final decision, then the SBA has 15 days in which to buy the forgiven portion of the loan from the bank, and that's how the loan gets forgiven. A lot of these items in 10, we've spoken through them or I've brought them up, so I'm not sure that there'd be that many questions on them. Just really item 6 is super important. Item 7 in terms of what equals loan forgiveness, that calculation is really important. Remember that it's payments made and costs incurred within that 8-week period. And then the 2 different items for, reductions. And that's really the top 10 in loan forgiveness. Question came, do you prorate health insurance? Yeah, so any health insurance premiums that you have paid, those can be included in. Health insurance can get a little bit tricky with self-insured folks. So unfortunately, I don't know how to answer that question more at this point in time because there wasn't a lot of facts. But health insurance premiums are in fact eligible payroll costs. And I would assume that those would sort of align with your payroll in the normal course of business.
So unfortunately, we're at 1 o'clock. I put 1:04. I want to keep listening to you, but make sure we'll get you to the screen where folks know how to get hold of you because you are a tremendous resource.
Yeah, the next one I think has us more, but that's the toolkit that I had mentioned earlier. And then if you go to the final slide, that has Dennis's and I's and phone number and email. Dennis, anything else?
No, I appreciate all the questions, and I hope it was a value add. And then please reach out to me or Kayamisha, and we'll see if we can help you if you've got follow-up questions.
So thank you so much. I will tell you, and I'll tell the folks who are participating today, I have been on TAP's website since the beginning. I used your resources from the get-go, and we were building on our webpage of resources. Tremendously helpful, as was this review here today. Thank you for the courtesy and your time. I know you're busy, and we are grateful for the time and the information today.
You're very welcome.
All right. Have a good weekend, everybody.
Thanks, Kyle. Appreciate it. Happy Friday.
Thanks.